Welcome. My name is Evan Unzelman. I am the CEO of CRT Experts, and thank you for joining our presentation on CRTs as stretch IRA substitutes. We are recording the webinar. We'll get an email out tomorrow morning with a link where you can watch a replay, parts of the webinar, whatever piques your interest. Just a quick overview, a lay of the land here today. Of course, we're talking about CRTs as stretch IRA substitutes. We'll talk about what I call the basics, how it works, where it fits, where it doesn't fit, how to implement the planning. And then we'll jump into what I call the beyond, which is once that decision has been made, let's put this planning in place. We know how it's implemented, but let's talk about the CRT design. We'll use an example. We'll compare a family who uses a CRT as a stretch substitute and a family who doesn't, but we'll also use that example as an opportunity to look at some design features when it comes to structuring the CRT that are, in our view, underutilized, and we'll have a chance to do that. Hopefully most or all of you are familiar with CRT Experts. CRTs are all we do. For several of us here at CRT Experts, we have spent our entire professional lives working with charitable remainder trusts. For me personally, in the early 2000s, right out of school, I was tasked with developing a secondary market for the income interest in a charitable remainder trust. Topic for another day, another webinar. But the income interest in a CRT is a capital asset, and like other capital assets, stocks, bonds, real estate, it can be bought and sold, can be used to create a new CRT with different terms, can be given to charity. And that's where I've spent most of and the team here, we've spent most of our careers working with CRTs, what we call secondary planning, helping advisors review CRTs and present to their clients the options, the flexibility that's available, and where appropriate, facilitating the sale or the rollover of the income interest. In doing that, we've looked at a lot of CRTs. The last count earlier this year, we looked at the team here, almost 10,000 CRTs over the last 20, 25 years. And so simply put, we've seen the good, the bad, and the ugly. And when it comes to CRT design, and we've used that specialized experience in designing CRTs to create a service line here where we're working with advisors at the very front end of the CRT life cycle and helping them ensure that the CRTs that they implement, regardless of the planning context, that the CRT design is maximizing the flexibility and after-tax value for its beneficiaries. And we'll talk a lot about that here today. We're headquartered here in Leesburg, Virginia. You can see our building up here on the screen. I'm a West Coaster. I was born and raised on the West Coast, so I've been back here 20 plus years now, but the history here on the East Coast just never ceases to amaze me. We were lucky enough to acquire this building here a couple years ago where we're headquartered here in Leesburg. We're in just about 40 minutes outside of Washington, and our building was built in 1825, a couple hundred years ago. So it's pretty cool. If you're ever in and out of Dulles Airport, look us up. But we're not here today to talk about the HQ for CRT Experts, though. We're here to talk about a problem and a solution for that problem. The problem, of course, is that the Secure Act effectively ended the stretch IRA. Instead of beneficiaries being able to withdraw income for their remaining lifetimes, they must withdraw it over a 10-year period. And of course, those distributions are going to be taxed at the highest applicable rate. So for a client who is tax sensitive, was previously going to use the IRA stretch, this creates a tax disaster. It's effectively a large tax on the IRA after the death of the IRA owner. But however you want to describe it, for many clients, those who had planned on their IRAs distributing over the lifetimes of their heirs, this creates a problem. But fortunately, with the CRT, we have a pretty natural solution. So when we think about an IRA, really at the core of it is tax efficiency. That's what's driving the value of the IRA. We are investing pre-tax dollars in a tax-free account. Even though the Secure Act ended the stretch IRA, so the IRA cannot be stretched beyond 10 years anymore, we can replace it with a charitable remainder trust. The CRT is an exempt trust. It's tax-free like an IRA. So upon the IRA owner's death, if that CRT is named the beneficiary of the IRA, it could take those IRA assets with no income tax. Like the IRA, the CRT is able to grow those assets tax-free. The investment advisor has the benefit of no tax drag on the investments moving forward while they're in the exempt trust. We'll look later at the income deferral, what putting a period of deferral up front on that income stream can also do. Not only can we invest these in a tax-free environment in the CRT, but with the CRT, we can also take advantage of an initial deferral period that can significantly accelerate the trust value growth and enhance what's eventually distributed down the road to its income beneficiaries. Like an IRA, also like an IRA, the CRT distributions are what's taxable. So this is where we're dealing with the taxation on the distributions to the beneficiaries. Unlike an IRA, though, CRT can eventually distribute capital gain. I say eventually because in the CRT or in the IRA context here, we've got a large slug of ordinary income that has to be distributed out first. For those of you who are familiar with the CRT taxation, how that works, it's a four-tier accounting structure that's taxed on a worst in, first out basis, lovingly called LIFO. So any ordinary income that the trust has to be distributed out first before we can distribute capital gain, then exempt, then corpus. So with these, with the CRT taking in that IRA, there's a lot of ordinary income that has to be distributed. But unlike an IRA, that CRT, once that's all distributed, that ordinary income, as long as a CRT is invested for capital appreciation, which it's going to be in the vast majority of cases, it can eventually distribute capital gain. It's usually 15 to 20 years in. If there's distributions being made, we're not in the deferral scenario. It's usually 15, 20 years into that CRT's life, we can get into that capital gain tier. So down the road, we actually have some tax advantages with the CRT, even compared to the old stretch IRA, which of course is not possible anymore. In terms of the tax and legal authorities, you can see a couple up here on the screen. In the 1990s, there were several private letter rulings that confirmed a qualified trust, like a CRT, can be the beneficiary of a qualified plan. And of course, we know that once the assets are inside the CRT, they are exempt from tax under Section 664, the Internal Revenue Code. So what we've been able to do, or what we're able to do here with the CRT, is restore that stretch. The CRT is preserving the pre-tax dollars in a tax-free account. The trust is growing tax-free under 664. The heirs are now getting significantly more money, and it's being stretched over, and we'll see with an example, not only their lifetimes, but in many cases, the third generation, the grandkids' lifetime as well. And we'll look at an example of that. So if we just look at maximizing after-tax wealth for the family, it's a powerful alternative to taking the assets during that 10-year window. Now, I will say that the decision here is not solely made through this financial after-tax value lens. We wish it was. The planning would be implemented in virtually all cases if that was the case. But of course, we have some clients who they're fine with the kids getting the money right away, regardless of the tax cost. And we can model and show, well, we've got not only this lifetime income stream, it's more after-tax value. You can see some of the other benefits up here on the screen in terms of asset protection involving more than just the kids, involving the grandkids as well. But it's usually not going to change their mind. So in terms of where it fits, and we'll talk specifically here in the next slide, but where it fits and where it doesn't, this is usually going to be the client who was previously using the IRA stretch. So for the clients who weren't looking at doing that, oftentimes there's really no way around the fact that they're fine with the kids getting the money, even if it's a poor tax outcome. So with when we're using a CRT, this is a standalone entity. And so what that means is it requires trust administration. And that puts an asset threshold, a floor, if you will, on the the size of the eventual trust, which means the expected IRA assets upon the IRA owner's death. We will usually say 500,000 or so is where this makes sense. So as long as we have 500,000 or more in expected IRA assets, this is not going to be an issue. Now, you can certainly have a CRT with less than $500,000 in assets. I mean, we look at CRTs all the time that have less than that in assets. But what we've discovered is, when you're looking at a $100,000 CRT, and there is in most cases, a fixed minimum in terms of just the cost for administering a trust, that can get relatively high compared to the trust value. So we will generally say 500,000 plus in terms of that, where you would start to look at this. Of course, we're looking at this as we get older. 50 and up is usually the rule of thumb that we use. And of course, we're interested in maximizing after-tax value for not only the children, but we'll see in our example here today, the grandkids as well in many cases. Who are not candidates, of course, clients who are going to spend most or all of those IRA assets, or the client who we talked about previously, where they're just not concerned that the kids are going to get the money quickly, even if it's coming at a dear tax cost, as is the case. So how do we implement the planning? Before we get into the implementation, just want to make a couple points. First, this has got to be done during the IRA owner's lifetime. This is actually helpful. When we think about certainly charitable planning, but just planning in general, I think if there's certainly everyone on this webinar with advisors, I think everyone could agree that one of the hurdles to implementing planning is just inertia on part of the client. This is helpful with that, because this is not a scenario where we can say, well, I'll instruct my executor to create the CRT. That would not work. This has to be in place, the planning, and we'll see there's different ways to do it, but the planning needs to be in place at the CRT or at the IRA owner's death. The second, and this will bridge us to the back half of the presentation, is CRT design matters. And this is the case whether we're looking at a traditional CRT creation. We've just got a client with appreciated property that wants to defer the capital gain, and they're going to be the income beneficiary of the CRT, probably with the spouse. It's certainly true there, but it's also true here. So we're going to talk about a couple design features in particular, but CRT design matters. All CRTs are not created equal, and we'll go through that. So when it comes to how do we implement the planning, there are three general ways to do this, and we'll talk about those, but they're all the result is the same with each way. The trust is named the beneficiary of the IRA. So we're going to go to the custodian of the IRA, fill out a change of beneficiary form, and name the CRT, the trustee of the trust, as the beneficiary of the IRA. So that's going to happen in each of these cases. Now, the way that we're implementing here is quite different, though. The first way that we'll talk about is with the funded CRT. So this can be an existing CRT, as long as we have the right language in the trust agreement. So most trust agreements will have this language that permits additional contributions, future contributions. So the language is going to go beyond just that. It's going to address how those are treated in terms of the distribution, the CRT distribution. They have to be prorated. But as long as the trust has that language to allow for future contributions, we can name an existing CRT as the beneficiary of an IRA. So the reason we don't see this a lot is because typically if we have an existing CRT, that's not the same structure that we're going to be interested in the stretch replacement context. Namely, it's not going to, in most cases, have kids on the CRT. But if it has the right structure, we can, if we got a husband and wife on there, and maybe the kids are already on there, we can go and it's the husband's IRA. We can go to the custodian of the IRA and name that CRT as the beneficiary. We can do this with an unfunded CRT. So we can create a CRT, fund it nominally, and these are qualified trusts as far as state statutes, but under federal statute, there's no requirement for administration, which makes this doable. If there was, we had administration requirement for a nominally funded CRT, that would not work. But when we look at this compared to the third option we see here, and which is most commonly utilized, and it's pretty obvious why. If we do this through a revocable trust or will, we have the big advantage of, like if we fund it nominally, we have an upfront cost to design it and draft it, but then there's no ongoing costs. But we have the ability to change the planning. We have the ability to undo the planning if something happens where they want to undo it. So we have that ongoing flexibility, which of course is going to be desired in most cases. So we can do this. It's typically done through a revocable trust. And maybe let's say a grandchild is born and we want to include a grandchild as a beneficiary. Maybe a child gets married and now we have a son-in-law or daughter-in-law who we want to include. So it gives us the ability to update that planning over time without any ongoing cost. We don't have to administer it until it's a CRT. So once we get to this point where we'd like to use a CRT as the stretch IRA replacement, now we're thinking about design, and we're starting to think about trust designation. Who are the income beneficiaries, the charitable beneficiary, trusteeship, and this is where it gets into really our bailiwick here at CRT Experts, which is designing CRTs that are designed for maximum flexibility and maximum after-tax value. There is a key difference here when we look at this context, planning context, compared to the traditional. Most CRTs that are out there today, there's about 85,000 CRTs that are out there in the country. Most of those were what I'm sure many of you on this webinar have done. So it's client owns that appreciated property. We've got $1 million in appreciated real estate. We want to diversify it, sell that asset, defer the tax, and now the client's going to be the income beneficiary. The donor is the income beneficiary of the CRT. No brainer there. They're going to want to be, if I'm the income beneficiary of the trust, I'm going to want to maximize the flexibility that I have, my value, within the Section 664. This is a different context, right? Because we have, the donor here is deceased. This CRT is effective when we're setting this up through a testamentary trust with this revocable trust or a will. The funding of the trust with the IRA assets, that's the trust effective date. That's when the CRT is effective. It becomes an irrevocable CRT at that point. Well, if I'm the donor, if I'm the IRA owner, I'm gone. So it is different here in terms of it's not always the case where the IRA owner, the donor, wants all that flexibility infused into the trust. If we have an IRA owner, a lot of times the remainder beneficiary here is a donor advised fund, the family DAF. And the IRA owner may not want the kids or grandkids to have the ability, who are income recipients of the CRT, to have the ability to adjust that. Or if it's the alma mater, it's nope, I want this set in stone when the CRT is funded. No problem. We just need to know that. So it's just having these conversations with the donor, with the IRA owner, to make sure we understand, okay, what flexibility do you want to provide here, and what do you not? Trusteeship is another one. There's concerns, sort of this a child who's what they call creative spender. We may not want that child to be the trustee, so we may want to use a corporate trustee to put some guardrails on there in terms of how the trust is invested. Make sure we're not being too aggressive, chasing yield for the distribution, something like that. So those are real traditional. We typically will see those things trusteeship, the charitable beneficiary, those would be worked into traditional CRT planning. But there's a couple areas, and it's the first two bullets we see here, duration and deferral, that we very often do not see included, and regardless of the planning context. And we're going to hit on those today. If you want a deep dive on those, we've got a link up here on the screen to a webinar we did where that's all we did is we drilled on what we call optimized CRT design, which is working predominantly with those two features, maximizing the duration of the trust and providing the ability to defer income. And we'll talk about both of those today through an example. So we're going to erect a working example here where we're going to compare taking the IRA through the CRT versus just taking the assets through that 10-year window. So we're going to have two families. Now, this is not a fair comparison. Spoiler alert, family B is going to win this one. When we preserve the tax-free environment, the IRA assets going to the CRT, we're preserving that tax-free environment. It's just not a fair comparison for the withdrawal from the IRA scenario where we're getting hammered from a tax standpoint during that 10-year window. But I want to present the numbers anyway, and this is also going to give us an opportunity to look at these a couple of these design features that I want to talk about. So that's setting the stage. So first, let's look at how we're structuring the CRT here for family B. So we're using the initial income beneficiary is the surviving spouse here. So that's not always going to be the case, but we're going to do that here. We'll talk about deferral later, and it'll become clear why we're doing that. This is a very common scenario that we see. But the spouse is the initial income beneficiary. And now we have two children who are the successor lifetime income beneficiaries. And then we have 4 grandchildren who are at the last of the children to pass, the 2 kids to pass. The grandkids are going to be the term income beneficiaries. So this is what's called a life plus or joint life plus term CRT structure. And we'll talk about that when we're talking about duration. But that's what we're using here. Now, one thing I do want to point out is in our example, at least initially, we're just going to use one CRT. But this planning can be done with multiple CRTs. Even if we just have 2 kids, we may want to use 2 CRTs. We'll talk about why later. But let's say we have 3 kids or 4 kids. No problem. We just need to use multiple CRTs. It should not, as long as the planning is all done, all this is done inside of the same general plan. We're using the same administrator. This should not be more expensive using multiple CRTs and doing it all inside of one. So for simplicity, we're going to just use one. But if you watch the webinar, we gave the link. In that webinar, it's not talking about the stretch IRA. We're just talking about maximizing value and flexibility within CRTs, what we call optimized CRT design. In that webinar, our working example, the Jones family, they have 3 kids and they use 3 separate CRTs here, where the donors are the income beneficiary of each of these CRTs, then each child and their spouse, and then the grandkids for the term. They're also using the life plus term here. So it's very specific as far as the ages of the income beneficiaries and whether income deferral is likely to be desired. That will dictate the number of CRTs we're typically gonna or we're going to choose in these scenarios. So let's look at the numbers. I would usually do this, graph by graph and then show the overlay, but I want to keep us on schedule here. So we'll just look at the overlay. So this is how the numbers are shaking out. So the CRT is the solid green line that you see there. So that CRT is able to take the IRA assets, the full $1 million with no income tax. We're growing in both scenarios, a 7% growth rate. That CRT is distributing. We have a 5% distribution rate on the CRT. That, in most of the planning that we do, the designs that we do, we're using that 5% rate, that minimum rate, because that's what's going to allow us to maximize duration. We'll talk about that here shortly. So that's the CRT. We can see here the 5% distributions there to the we can see with the vertical green line. So that's that 5% distribution each year. The solid red line is the IRA. So it's distributing all its assets over the 10-year period. And the dotted red line shows the value of the money withdrawn from the IRA or after taxes and spending that's reinvested. So we take the withdrawal from the IRA, we pay our tax, we are going to we're going to assume the heirs are going to spend the exact same amount as what they would be getting from the CRT. So we're going to keep everything apples to apples. The heirs are going to spend the same amount in each scenario. So we're withdrawing from that reinvested IRA account the exact amount that the heirs receive from the CRT. And that's the vertical red lines. And you can see those are exactly the same until the IRA money is all gone. And you can see the ultimate result here is more than double the amount of income that's paid out over the CRT when we compare that to the withdrawal from the IRA scenario. I mean, it's pretty obvious why it doesn't take a rocket scientist to figure out. It's that immediate tax hit on that IRA is just too much for that strategy to overcome if we're going to compare it to the CRT that's exempt and is able to maintain those assets in that tax-free environment. Another thing that we can see here is we can see, remember I mentioned earlier that we have to go through all that ordinary income first. That $1 million, we have to distribute all that out. But once that's all distributed out, then we can get into the capital gain tier. We can start to distribute capital gain. We can see right where that's happening, right there. We can see the little jump there in the CRT distributions, and that's because these are after tax. So we're paying a lower effective tax rate once we've gone through all that, and that is what, year 18 there, and that's pretty typical. So let's talk about duration. So when we've made the decision to use a CRT to replace the stretch, one of the first design features that we're going to look to is maximizing the duration period. And so when we think about maximizing the duration period, by duration period, we mean the period over which the trust will distribute income. And generally, we're going to want to include as many family members as possible. I mean, that's going to be our goal. Right now, with where the IRS 75/20 rate is, we'll talk about the 10% test and how that's what we're up against here in a second. But given the current rate, the duration, the expected, if you just use life expectancies of the CRT, should be 50 to 60 years. So if we're not maximizing that, we're, for most clients, yeah, we may get a larger deduction, or we can turn that payout rate up a little bit, but mostly in most cases, if instead we can add an entire generation as an income beneficiary, that's the way that the client will choose to go. When we're maximizing duration, we are up against what's called the 10% remainder test. I'm sure many of you are familiar with the test. It's an actuarial test, so it's the actuarial value of the trust at inception. So this is when, in our scenario here, if we're doing this through a revocable trust, it's going to be when that IRA owner passes, that trust is now effective. At that point, we're going to plug everyone's age into a software. We'll see the output here in a second. The current 75/20 rate at that time, and the payout rate of the trust, and that's going to tell us, per an IRS formula, this is the percentage on a present value basis of the assets that are projected to go to charity. That has to be at least 10%. So when we're maximizing duration, what we're going to do is we're going to get as close as we can to that 10%. And most of the time, we're going to be using this life plus term structure. Even in many sophisticated practitioners that we talk to, in many cases are unaware of this. So it's the perception is, well, I can create a trust, a CRT for the lifetimes of the income beneficiaries, or I can trade it, or I can create it for a term with a maximum of 20 years. Sure, we can do either of those, but what we can also do, and you can see that the part from 664 up here on the screen that gives us the ability to do this, is we can structure to go for these individuals' lifetimes plus the shorter of these individuals' lifetimes and a term of years, maximum of 20. It is the shorter of their lifetimes and that term. But just from a life expectancy standpoint, it's almost, unless there's just premature death, extreme premature death, it's always going to be that term, because in our example here, those grandkids are always going to well live that term. In a lot of cases, that's why we're using the family donor advised fund. Once that term is up and the trust is distributed to the donor advised fund, now the grandkids can give the money out of the donor advised fund. So when we're structuring here for maximum duration, so we use two versions of software. We use Crescendo Interactive and Easy Charitable. So one thing I like about Easy Charitable is I'm sure many of you know Lee Hoffman. This is his software. One of the things I like about Easy Charitable is it will allow us to absolutely maximize this duration. And what I mean by that is, you could see up here on the screen, we can go out to the day in terms of how long can we stretch that successor term out before we fail that 10% test. So you can see here on the left of the screen, we have our input. So we're going to input the 75/20 rate. Again, this is done at the effective date. So we're going to input our 75/20 rate at that time, that IRS interest rate. We're going to input everyone's ages, and we're going to note who the income beneficiary or the lifetime income beneficiaries are. In this case, it's the surviving spouse and then the two children. And then we have our four term beneficiaries. And what we want to do is figure out how long can we stretch that term after the last of those three lifetime income beneficiaries to pass. So we'll start at 20 years, and this, as we can see here, would have failed at 20, and we'll just start pulling that back until we find that maximum turn. You can see in this case, it's almost 18 years, 17 years, 10 months. And we can see over here, this is the actual calculation that we're just scraping by that 10% test. That's usually the goal, is in maximizing that duration. So that's the first thing we're going to look at. The second thing we're going to look at is it anticipated that some or all the income beneficiaries, it's usually not going to be all, but some of the income beneficiaries may want to defer income. Now, this is going to be particularly true with the older income beneficiaries, that first generation. So we're going to look at the spouse in our context here. So why would we put a spouse on there who is not anticipating taking any distributions, is just anticipating deferring? Well, we're going to see why. It just allows delaying the distributions at the outset, just allows the trust assets to compound more rapidly and just grows that trust value up. It accelerates the growth of the trust. So whenever that's anticipated, it's possible the spouse may not, or if we're setting it up, maybe anticipating that one of the kids will, or both, they may not. But we want to structure it and give the beneficiaries that ability. And the way we're going to do that is using what's called a net income with makeup CRT, a NIM CRT. I'm sure many of you or all of you are familiar with NIM CRT. So a NIM CRT will distribute the lesser of a stated payout rate and trust accounting income. So there's this net income limitation. It's never required to pay the beneficiary more than its income. So if it doesn't have income, nothing has to be distributed. And the makeup provision enables us to pay that deferred or unpaid income in future years. So there's this catch up or makeup provision where we can pay it out in future years. So those two things, that income exception and the makeup provision, those are what we can use to control the timing of the distributions from the NIM CRT to the beneficiaries. It's all centered around trust accounting income. So trust income is a cash concept. And what that means is we will not have income if the trust does not have a cash receipt. And there are several techniques to control the timing of trust receipts, and thus with a NIM CRT, the timing of that accounting income. But they all work the same way. There's going to be it's usually called a container that's going to hold the trust investments. Common examples would be a variable annuity, a partnership. What we would usually recommend would be a single member LLC. And we would recommend that because it's compared to those other two, the partnership and the variable annuity, it's just a better tax and administrative outcome. But whatever that container is, we can hold all the investments in there. And until there's a distribution to the NIMCRUT, there's no accounting income. And so even when we compare that to still a NIMCRUT, but a NIMCRUT that owns those investments directly, it's hard to control some income leakage. I mean, we're going to have interest and dividends that with a traditional NIMCRUT would have to be paid out. Whereas with this, as long as we put this additional structure on there, we can keep all of that income trapped inside that container until it's desired. This is high level. There are many technical details here with this design that need to be followed. But want to give some context about how we're doing this. And those details are well beyond the scope of this presentation. But if you want to deep dive on those, go watch that webinar that I mentioned earlier that's up on our website. If you're having trouble going to sleep late at night, it'd probably do the trick too. But it's in all seriousness, this is something that I think when we look at this compared to the life plus term, I think this is more known in terms of, yeah, you can use a NIMCRUT to control the distribution, the timing of those cash distributions, but it's in terms of how it's implemented. If you're interested in that, I think that webinar will be of interest, or just my contact information will be up at the end. I'm always happy to kick this stuff around. So in our family B here, we're going to assume that the spouse defers income, and we're going to look at the impact. And this, it's probably more times than not, at least in the ones that we're involved with, that this is how it plays out, where we're going to put this trust into deferral. And it's usually, like I said, going to be during that first generation. When we think about, the income beneficiaries here, typically, even in a traditional CRT scenario, the donors, if we have multiple generations, are typically the ones who are most likely to want to defer income. So we're just going to make one change to our planning, and not a change to the planning, just the way that it plays out. And that is, let's assume the spouse, the initial lifetime income beneficiary, defers income. So what that's going to do, family A is exact same, no change to family A. But what that's going to do, if we put that deferral period, that's that initial deferral period, which just accelerates the trust value growth over that period, you can see the trust value is able to grow up much quicker. So what that's going to do is, to the extent that we're deferring income up front, we've got this deferral period up front, that's going to enhance what we can distribute later on. And we can see the increase here for family B. We've gone from 3.586 million distributed in just the level distributions just every year. The spouse is taking it, then the kids, then the grandkids. Now we've gone, just putting that trust and deferral for 10 years, the surviving spouse's life expectancy, we've increased the overall family income to north of 5.2 million. So, I think of it like, it's like giving the trust a runway to take off. Like that early deferral just boosts long-term value. It's where it's tolerated. In many cases, it's desired. It can really augment what's distributed down the line. And so I mentioned earlier, let's go back to, okay. Oh, I'm glad I put that in there. So you can see here now the point where we get through all that ordinary income, it's a little bit later, right? Because we deferred, but you can see that shoves that into year, I think 20, that is. So it was 18 or whatever it was before. So it's a little bit later because we haven't taken those distributions. So it takes a little bit longer from inception to get through those. But you can see there, that's where that little increase happens in the distributions to the heirs. And that's because we're now into that capital gain tier. We're paying a lower effective tax rate. Let's assume, so I mentioned earlier, we may want to do this with two different CRTs. And here's why. In some cases, it's anticipated that one or more of the kids may also want to defer income. And so if that's the case, but we have another child that's very likely going to want the income, yeah, we can use a discretionary trustee, but it's much simpler. Let's just use multiple CRTs, just one for each child and one for each family unit. and again, this can be 3, 4 CRTs. It doesn't, that's what trust administrators are for. This doesn't get more complicated from the family standpoint. It shouldn't be more costly. But if we use those CRTs, then we can customize the CRT for each child's family. Now, if we only have the child as a successor income beneficiary, so when the spouse passes away, it's just the child, we do have considerably more mortality risk here, because now instead of having both kids as the measuring wise, we only have one child. So what we may want to do here is bring the spouse, if there is one for the child, that the son-in-law or daughter-in-law, include them as well. That way we lower the chance that child dies prematurely, and the grandkids get paid earlier, but they're not going to get as much money. So that's why we would oftentimes do this with one CRT, but if we're doing multiple, if we can, just depends on everyone's age, including the spouse, the son-in-law or daughter-in-law, oftentimes will make sense just from a mortality risk standpoint. So there's lots of different ways we can go here. There's lots of different options when it comes to how we can design and structure the CRT. But to just kind of go back and just put a bow on our discussion here, we're using a CRT to restore the stretch. We're preserving those pre-tax dollars in that tax-free environment. It's got to be done during the IRA's owner's lifetime. We cannot kick the can on this. This has got to be done during their lifetime, which from the advisor standpoint is often helpful in overcoming that inertia. There's different ways we can implement it. We can use a funded CRT. We can use an unfunded CRT, a nominally funded CRT, or in most cases, we're going to do it through revocable trust, sometimes a will. That gives us that flexibility up until the IRA owner's death. When it comes to structuring the CRT, now things get a little bit broader in terms of the different directions that we're going to go. But some of the key things we're going to think about is we want to include as many generations as we can. Is some deferral likely to be desired? If so, and that can mean in many cases we put the surviving spouse on as that initial income beneficiary, so we can put that trust into deferral for some time. So there's lots of possibilities here. Ultimately, when it comes to CRT design, where ultimately what we want to do is maximize the after-tax value to the heirs, in this case, to the income beneficiaries of that CRT. So hopefully this has been helpful for everyone, enlightening. My contact information is up here on the screen. Even if you just have general questions, just do not hesitate to give me a call, shoot me an email. We're always happy to answer those. Chances are we can, and if it's a stumper, we will get you the answer, because we should know the answer if we don't. So don't ever hesitate to reach out to us with just general questions, certainly questions about what we've talked about today, the CRT as the stretch IRA replacement, those design components that we talked about, life plus term, using NIMCRUTs. We love it. We're CRT nerds here, and we're always happy to entertain those conversations. But at a minimum, I hope this has been helpful for everyone. I appreciate you joining us. I hope everyone has a good rest of the day, rest of the week, and we will hopefully hear from you sometime soon. Thanks again.